Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Do you want less greenhouse gas emissions? You want less plastic in our oceans? Do you want to increase the availability of clean drinking water? Do you want to eat healthy organic foods instead of processed foods? Do you want to promote gender equality and increase diversity and inclusion? If you answered yes to some or all of these questions, then sustainable investing could be for you, and you would not be alone. Hi, my name is Jason Adams. I'm a portfolio manager at Fairport and Luma Wealth, here to talk about the soup to nuts of sustainable investing for September's version of the Fairport Flash. So let's start by defining sustainable investing. The definitions vary depending on who you talk to, but here's the way our partners at BlackRock define it, which I kind of agree with. Sustainable investing is investing in progress and recognizing that companies solving the world's biggest challenges may be best positioned for growth. It involves pioneering better ways to do business. Sustainable investing allows investors to align investment decisions with personal beliefs. And it's a combination of traditional investment approaches with ESG insights. Then there are different types of sustainable investing. The broadest and most well-known is environmental, social, and governance investing, also known as ESG investing. I believe the terms ESG and sustainable are largely synonymous. And for the rest of this podcast, I'll use the terms interchangeably. So don't let me using sustainable or ESG confuse you. It's basically the same thing. So there are several types of strategies used in this sustainable ESG universe. You have socially responsible investing, which is, most often is associated with a religious affiliation. You have impact investing, which is targeting direct investments that make an ESG impact, such as investing in green bonds that are raising money to build a solar power plant. Thematic investing, which is investing in a particular theme within ESG. Clean energy is a good example. And then you have negative screening, which is eliminating certain companies or industries. And positive screening, which is targeting certain ESG criteria and investing in only those companies that exhibit those criteria. So this chart helps explain what environmental, social, and governance factors are. The table defines sort of environment, social, and governance, and then the pie chart dives deeper into each of the categories. So this is pretty self-explanatory. So now that you kind of have an idea of what ESG investing is, let's talk about the tremendous growth that the industry has seen since the turn of the century. Since the establishment of the United Nations Principles of Responsible Investing in 2005, the amount of assets under management by PRI asset managers and owners has increased from less than 250 billion to almost 28 trillion as of the end of 2020. When measuring growth as measured by more traditional ESG metrics, it paints a similar picture. Assets under management using ESG criteria has increased more than sixfold since 2007 to over 17 trillion, as you can see on the chart on the left. And the number of firms incorporating ESG criteria is up by a factor of 3. With this remarkable growth, the industry has seen the number of tools available to participate in ESG investing increase dramatically, thereby making it much more accessible. So ETFs, as you can see in this chart, are extremely low cost and tax efficient ways to participate in a particular asset class or factor or criteria. And you can see comparing the growth of ESG ETFs to normal ETFs. I mean, normal ETFs have grown great, 21% per year for the last 5 years, but look at the growth rate of the ESG ETFs, 78% per year for the last 5 years. You can find ETFs that are impact investing. You can find thematic investing, socially responsible, and then obviously the broad ESG investing universe. So part of the good news related to this growth is that ESG is working. As the community of ESG investors grows and more money floods into the space, it's causing companies to change how they do things, change their behavior, as evidenced here. This chart shows how many companies are now disclosing ESG information as part of their regular reporting practices, a pretty striking change in a relatively short period of time. And this is important because as ESG reporting increases, boardrooms and executive management teams' decision-making processes will surely place more weight on those ESG factors. In this slide, you can see that companies within the S&P 500 are improving their ESG scores across the board. which again shows that the changes are happening in corporate boardrooms and executive management teams. So while corporate behavior is clearly changing and ESG investors should feel aligning their investments with their values is absolutely making a difference, the second part of the ESG equation is investment performance, and does ESG investing in fact lead to superior investment returns? Because of the discrepancies in ESG ratings and varied methods of determining ESG scores, it's difficult to prove empirically that higher ESG ratings equals higher returns. The best study I've read was done by Gautam Dhingra and Christopher Olson. They studied a data set between 2008 and 2019 to determine if companies with high ESG scores outperform those with low ESG scores. So looking at this chart, it's pretty close. So the results of the study showed that the companies with high ESG scores did in fact slightly outperform, but the authors could not prove that they outperformed because of the ESG factors. What the study did show, however, is that the high ESG portfolio exhibited higher quality and lower risk than the low quality portfolio. And so I think, in regards to answer the question of whether ESG investing produces superior returns, I would argue that while it may not in absolute terms we can't prove that it generates better returns, I think when you look at returns on a risk-adjusted basis, I think you can certainly make a case that ESG reporting is, or ESG investment performance is generating better risk-adjusted returns. So as the ESG industry speeds into the third decade of the 21st century, I believe ESG will continue to provide investors the ability to align their beliefs with their investments and impact the world in a way that's important to them and change corporate behavior. I expect the ESG rating process to improve and get more consistent. I expect technology to continue to improve transparency and accessibility. I also believe ESG solutions could drive superior investment returns over the next decade. We already know considering ESG factors results in portfolios that exhibit higher quality and lower risk. Add to that the growth in the industry. Demand for sustainable investments is increasing faster than the demand for traditional investments. All else equal, that dynamic could drive a higher price appreciation. You have demographic shifts. A younger, more diverse set of investors will continue to accumulate wealth and look for sustainable solutions at the heart of their portfolios, further increasing demand. You have government policy, which is a significant tailwind. U.S. wants to cut carbon emissions by 50% by 2030. The U.K. plans to cut emissions 78% by 2035. Over 50 countries, including the U.S. and China, have enacted net zero policies or removing from the atmosphere the same amount of greenhouse gas that they emit by 2050. In a recent version of the U.S. infrastructure bill, there was $3 billion in battery material grants, $7.5 billion for electric vehicles charging stations, $8 billion to produce, transport, and store low-carbon hydrogen, amongst several other investments in sustainable technologies. Expect the private sector and the companies, these sustainable companies, to take full advantage of this, and the investors that invest in those companies to be beneficiaries. Lastly, inherent in sustainable investing is the attractiveness of companies pioneering better ways to do business and trying to solve the world's biggest problems. As we learned from the 2020 COVID pandemic, when companies were forced to find new ways to do business and address huge problems, the result is improved business models, enhanced productivity, and outsized returns. To summarize, if you are currently or considering becoming an ESG investor, you are indeed a part of a powerful community successfully changing the world and reflecting your beliefs. Still a long way to go, but the changes are happening. Going forward, take peace of mind that considering ESG factors does not adversely impact your investment returns. In fact, your portfolio could be higher quality and less volatile than a traditional portfolio. And I personally believe there's a good chance ESG investors could indeed generate superior investment returns over the next 10 years due to the growth of the industry and increasing assets under management, demographic shifts, policy tailwinds, and the power of community. At Fairport and Luma Wealth, we already have several well-diversified investment solutions with strong investment performance track records considering ESG criteria. And soon, we may be offering a strategy to customize your ESG portfolio around what is most important to you, while at the same time generating market returns and enhanced tax efficiencies. More to come in the near future. Stay tuned. If you would like to talk further about ESG investing, or if you have any questions or would like a copy of any of the slides in this podcast, please do not hesitate to reach out to your advisor. Thank you so much for listening. All the best.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims that make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.